Good morning, ladies and gentlemen, and welcome to our second virtual Outcome Matters event for this year. This year has been tough for markets globally and locally, and you will recall that we mentioned in our last event that these kind of occurrences have happened in the past, they'll happen again, and markets will recover as they have in the past. The 2020 stock market crash, also referred to as the coronavirus crash, was a major and sudden global stock market crash that began on 20 February 2020 and ended on 7 April. The crash was the fastest fall in global stock markets in financial history. The crash, however, only caused a short-lived bear market, and in April, global stock markets re-entered into a bull market. Join us today as we provide market insights, research insights, and fund management insights to help you and your clients navigate these paradigms. Just some housekeeping to get us going. We've shortened our session to an hour to really make it punchy. We know you, like us, are getting virtual conference fatigued. We won't have a live Q&A. However, please add your comments and questions in the chat function on Zoom, and we'll get back to you within the next 2 days after the event. Please follow Momentum Investments on LinkedIn at Momentum Investments and Twitter at MomentumINV_ZA for posts during and after the event. You can also tweet during the event using hashtag Outcome Matters and hashtag Investments. The event will also be added to the Momentum website at momentum.co.za. Click on Investments and Savings and search for events. First up is Sanisha Pakrasamy, who's the economist at Momentum Investments. She'll be talking to us about our world in the next 5 years in terms of markets and the economy. Welcome, Sanisha.
Thank you, Andile. I'm Sanisha, the economist for Momentum Investments. It is hard to believe that the world has been living with the threat of COVID-19 for nearly a year now. Much of the globe was taken off guard by the pandemic, and with no proven cure initially, the primary course of action was just to impose social distancing measures. Subsequently, numerous governments around the world ordered a near complete shutdown of the economy. But it soon, however, became abundantly clear that such measures cannot be sustained for extended periods without inflicting severe economic damage. So to counter these negative effects on growth, policymakers acted swiftly to deploy unprecedented stimulus measures. But even with this in place, many economies experienced an historic contraction in growth in the second quarter before they actually started seeing activity picking up again in the third quarter. Now, in previous sessions, we looked at the havoc unleashed by COVID-19 on shorter-term economic outcomes. But today, I want to delve into how we see the world economy evolving in the next 5 years in a post-COVID-19 world, and also to take a look at what investment implications that this may have. Now, the pandemic continues to dominate headlines. Uncertainty over socio-economic and political outcomes remain quite high, particularly with the recent flare-up in European infection rates. And so to take account of this heightened uncertainty, we approach the outlook for the global economy as well as financial markets for the next 5 years with a scenario-based analysis. So here we consider 3 possible pathways for the global economy in the medium term. Now, we've called the first of these scenarios the muddle through, which we also see as the base case for the next 5 years. And we've attached a 60% probability here. Now, this is a scenario in which there is a continuous interaction between global growth outcomes and additional monetary and fiscal policy measures. So what this means is that as economic activity shows signs of slumping, policymakers react by deploying additional stimulus measures just in order to bolster activity in the economy. But on the flip side, when economic activity starts to strengthen again, it actually allows policymakers to take a bit of a backseat. Now, even though stimulus does come through to support the global economy when necessary in the base case, these policy efforts are only partly effective in offsetting the negative effects of firstly the global financial crisis and of course more recently the COVID-19 pandemic. We also consider a more downbeat scenario, which we call the deflation case. Aging populations and continued technological advances keep the scenario ranking as the second most likely at around 25% in our view for the next 5 years. So this is a typical risk-off case where monetary and fiscal tools largely fail. So even though interest rates are really slashed even beyond the zero lower bound, we actually assume that this fails to revive confidence and demand. So the economy essentially slips into what we call a liquidity trap. So this is really where central bank efforts to try and stimulate spending essentially fail, and consumers and businesses want to hoard cash rather than spend it in the economy. Thirdly, we also take account of a more optimistic scenario, which we call reflation. Here we assume that there's massive growth in money supply, and this is really in response to the COVID-19 pandemic and slowing globalization, which ultimately leads to higher levels of inflation. Now, despite this being the most positive from the three scenarios, reflation unfortunately holds the lowest probability of playing out in our view. The pandemic has been a game changer for shorter-term growth outcomes. The EIU has forecasted a recovery in world GDP levels back to pre-COVID levels only by 2022. Now, not all countries have had the same response to the pandemic, and this was largely because policymaker reactions have varied, and countries have also had very different levels of available resources to help to curb the spread of the virus, but also to cushion the economic fallout. So it comes really as no surprise that even in the muddle-through scenario, all of these countries will not recover to the pre-COVID levels at the same time. So if we look at the economies that were first hit, such as China or in Indonesia, they've actually managed to contain their initial outbreaks, and they will likely be the quickest to recover from the hit of the pandemic. However, if you look at countries like South Africa, we actually entered the COVID-19 crisis on the back foot, so here economic pain is expected to be felt for a bit longer. Now, despite unprecedented levels of both fiscal and monetary stimulus being deployed to try and arrest the decline in economic activity, we believe that ongoing stimulus efforts are necessary to preserve investor confidence throughout financial markets. Now, South African policymakers were really no exception, and they reacted to the pandemic by deploying the sixth largest fiscal stimulus response relative to its emerging market peer group. Similarly, the South African Reserve Bank reacted quite swiftly and quite decisively, and they actually managed to cut interest rates ahead of many other emerging markets. South Africa was also sitting on relatively high real interest rates at the start of 2020. So this really allowed the central bank to meaningfully cut interest rates here. But despite these concerted stimulus efforts, the impact on growth has been lacking in South Africa on a comparative basis. Our economy is still set to experience the third worst economic contraction from its relative peer group this year. Now, even in the muddle-through scenario, we still see big constraints to South African growth. These include things like electricity supply constraints and an uncertain policy climate, which continues to deter investment in our domestic economy. South Africa's dire fiscal situation just adds to the country's growth woes. Even in the muddle-through scenario, South Africa would have to grow its economy at 4%, or alternatively, would it have to achieve a primary fiscal surplus of 6% just to stabilize debt levels. Now, this is a far more onerous ask than for many of South Africa's emerging market peers, as you can see from this chart. What's more, an increasingly noisy political backdrop in the past decade has also contributed to the rise in policy uncertainty locally, which is negative for both long-term investment and spending decisions. South Africa also faces an influx of younger, now eligible voters who are also likely to shift the voter landscape. Increasing youth frustration has also led to a rise in voter apathy, which is quite evident in the steep drop-off that we've seen in the voter turnout at the last round of elections. These changes in voter patterns could essentially create quite a noisy backdrop for the local economy. Political stability also hinges on the strength of the incumbent administration. Now, despite a few setbacks to the level of support for President Cyril Ramaphosa earlier on in the lockdown, Ramaphosa still holds a popular mandate in our view. Sentiment surveys that are highlighted here show that Ramaphosa remains more popular than government, but he also continues to rank as being more popular than any other potential presidential contender within the ruling party as well as externally. In our view, this could allow for some political stability and a little bit of progress on structural reform, which should then help lift sentiment from the currently decimated levels that they are currently at. In our view, Ramaphosa has used his popular mandate to channel his support towards furthering the anti-corruption drive. South Africa ranks poorly on worldwide governance indicators that are related to the control over corruption, and the country finds itself ranking on the wrong end of this chart. Now, how successfully South Africa emerges from the COVID-19 pandemic and its ability to find a firmer economic foothold will largely depend on three main flags, and we are keeping a close eye on these. So firstly, will South Africa experience a second wave in COVID-19 infections? If so, how severe will the health and economic impact be? Secondly, we're also closely monitoring the level of transparency and action that we see on the economic plan that has been broadly agreed upon by the country's social partners. And then thirdly, we're also tracking whether the momentum behind the president's anti-corruption drive remains positive. Uncertainty is not only a key theme that is playing out in our local environment, but it also features very strongly in the global backdrop against which we operate. So it's quite handy to have a set of economic markers that can better inform us of how we are tracking these three scenarios. Now, under our base case, things like growth, inflation, and interest rates are expected to only partly recover, and these will likely remain below pre-crisis levels. The first global marker that is likely to give us some direction on whether we are indeed tracking the base case is the outlook for the euro-dollar. Now, in a typical muddle-through scenario, one would expect the US dollar to weaken, firstly on an improvement in sentiment, secondly on wider twin deficits, and thirdly, of course, on highly polarized politics. Now, in this scenario, we do see a further consolidation of those first European steps that have been taken towards forming a central fiscal capacity. So this, in our view, points to a higher likelihood of survival for the euro project. Now, the second global marker here is the trajectory for China. And here in the muddle through, we see potential growth in China slowing off a very high base, but still managing to avoid a crash because of the ongoing structural reforms in that country. Now, during the COVID-19 crisis, countries really learnt the hard way that an over-reliance on global supply chains can be very dangerous. Therefore, we continue to see a rise in protectionist measures even in the base case scenario. Decent Chinese growth then maps out a path for the third global marker that we're looking at, which is commodity prices. Now, further out in the 5-year scenario, an eventual growth recovery and some dollar weakness would actually be positive for industrial commodities and platinum. However, gold, on the other hand, would benefit in the short term because of negative risk sentiment, but further out gains would be capped as the opportunity cost of gold starts to pick up in line with the recovering global economy. So where does South Africa fit in this muddle-through scenario? Well, here we'd expect potential growth to remain relatively weak at around 1.5%, as policy implementation is still quite slow. Inflation in this muted growth environment would likely average around 4.5%, and the repo rate would gradually rise to a peak of nearly 6% over the 5-year time frame. Muted growth does very little to actually help South Africa's fiscal situation here, so we would still anticipate further downgrades, but on a staggered basis. And the rand, in our view, would at times find cyclical support, but it would ultimately remain fundamentally weak given South Africa's underperformance against its emerging market peers. Now, the consequence for asset class returns under a typical muddle-through scenario is that the highest returns in our base case are likely to come through from a combination of growth asset classes, which is property and equity, as well as South African fixed income. But in contrast, the lowest real returns for the next 5 years in this base case scenario are likely to come through from global bonds, global cash, the gold ETF, as well as the platinum ETF. Now, in our base case scenario, the expected real market returns from a typical balanced portfolio will still be constrained, and we assume that they will be around 2% lower than what we've seen in the past. In our worst case, or our deflation scenario, we suggest that policy tools are ineffective in offsetting the after effects of the crisis. So here, confidence really remains in the doldrums, and spending and investment is continuously postponed as a consequence. This is really a typical risk-off scenario. So safe haven assets, including the US dollar, would likely strengthen. And across in Europe, very dismal growth outcomes would ultimately result in higher levels of unemployment. This could stir up social unrest, and in our minds, this raises the probability of a breakup of the Eurozone. Even emerging market growth would perform poorly here. China in particular would likely slump into a hard growth landing, as debt worries spiral in the absence of decent growth. This is a very weak demand environment, which would be quite negative for industrial commodity prices and platinum. In contrast, a further reduction in real interest rates and a bigger depreciation in the South African rand should actually support the gold price. In the worst case scenario, South Africa's potential growth rate plunges to barely 1%. This dismal growth performance really spells bad news for an already expanding fiscal deficit. Under the deflation scenario, the probability of a growing government presence rises significantly. So this could give rise to the emergence of very market-unfriendly options to try and deal with South Africa's debt issue. So this could really include the introduction of things like prescribed assets or outright quantitative easing by the South African Reserve Bank. Now, downgrades to SA sovereign rating in this scenario would probably occur at a much faster pace in our view. Coupled with global geopolitical risks, a worsening domestic climate would ultimately weigh very heavily on the South African rand. And even with a significantly weaker forecast on local growth and a much weaker currency and high regulated tariffs, these would ultimately keep inflation averaging around 3.5%. So here we'd see lower inflation and tepid growth, prompting further interest rate cuts, with the repo just above 2% at its trough. Under deflation, capital preservation becomes the main investment objective. So growth assets typically don't do well when corporate profits are under severe pressure. However, things like gold, local bonds, global bonds are all expected to outperform their longer-term historical returns. Nonetheless, these asset classes do hold a much smaller weighting in a typical diversified portfolio. So therefore, if you're looking at the expected balanced portfolio return in deflation, it will still likely be the lowest by far among the three scenarios. To round off on a more optimistic note, we consider a third and final scenario, albeit at a lower probability of 15%. Reflation delivers the best growth outcomes for the globe, as stimulus efforts successfully bolster confidence, and this really drives a self-sustaining recovery in the globe. This higher level of demand spurs on inflation, and ultimately interest rates start to normalize in this environment. So this is a typical risk-on setting in which the US dollar weakens because investors are not actively seeking safe haven assets. Growth in emerging markets is essentially back off to the races here, and Chinese growth is assumed to be strong enough to actually offset any rise in debt levels. This higher growth level also continues to underpin industrial commodity and platinum prices. However, looking at the higher real interest rates and a lower risk setting in reflation, these things do not bode well for gold prices. We have a better global backdrop, and we also have higher commodity prices, so this really benefits South African growth in reflation. So here we would expect a more favorable potential growth rate of around 2.5%. Higher growth and also a faster progress on the country's reform agenda would ultimately help to stabilize South Africa's debt situation. And this, in our mind, would really appease rating agencies, so we would likely see South Africa gradually shifting back towards its investment grade status. An improvement in risk appetite would likely allow the rand to erode some of its undervaluation, so we would expect a stronger 5-year average on the rand in this scenario. Even though more robust demand should drive inflation higher in the reflation scenario, we still assume that the Reserve Bank remains very committed to its inflation targeting mandate. So to prevent runaway inflation, interest rates would have to be hiked to a peak of just over 7% in the next 5-year period. In reflation, the scale of outperformance of the growth asset classes is much more marked than what you would expect in the muddle-through scenario. However, a strong rand and rising global interest rates tend to act against the performance in gold, global bonds, global cash, and platinum. Nevertheless, almost half of the asset classes shown here are expected to outperform their history in inflation-adjusted terms in the reflationary environment. As such, the expected return on a diversified, balanced portfolio in reflation would not only be the highest among the three scenarios, but it would also probably provide a marginally higher real return than what we would have seen in the past. If we take these three scenarios into account, we would attach a combined probability of 85% to either a base or worst case scenario, where expected real market returns from a diversified portfolio in the next 5 years should in fact be lower than in the past. However, our outcome-based investment philosophy at Momentum Investments incorporates access to alternative asset classes and different specialist managers to try and increase the likelihood of us boosting absolute returns for our clients' portfolios. Thank you for engaging with us today.
Next is Jean Badenhorst, who's the Head of Investment Manager Research at Momentum Investments. He'll be discussing how a robust investment manager research process supports our fund solutions. We know that in a world of more than 2,000 funds, our jobs as advisors is near impossible to pick the best investment manager. We also know that it doesn't always lead to clients' objectives being met. So like you, I'm interested to see how this is done by the experts. Welcome, Jean.
Thank you, Andile. Hi, I'm Jean Badenhorst, Head of Manager Research at Momentum Investments. In this session, I would like to speak about 4 things. The first is to discuss what the edge is in our manager research process. The second is to explain why we follow a multi-specialist, multi-style approach. Thirdly, how we find and select superior investment managers. And finally, what actions were taken during COVID-19 pandemic to improve investment manager return outcomes going forward. Many fund selectors will say they evaluate the 4 Ps: people, philosophy, process, and performance. But in reality, the 4 Ps are more likely performance, 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 and performance. Everyone uses the disclaimer that past performance is no guarantee of future results. But it definitely seems to be the standard that many use to make their future allocation decisions. However, if the very first step in the evaluation process is a performance hurdle, then performance becomes the primary governor on the entire effort and is therefore the dominant factor. It's no wonder why fund selectors start there. Nothing compares with the ease of a performance screen to reduce the universe of possibilities down to size. In comparison, manager due diligence that focuses on people, philosophy, and process is much more challenging. Most investment managers have a great story to tell about their edge, what differentiates them, or why they are better than their competition. Very few potential investors spend the time assessing how realistic these claims really are, because there is no way that all these investment managers have an edge. These claims are rarely backed up with hard evidence. Those investment managers who don't have a well-established and documented philosophy are the ones who are constantly making unnecessary and costly portfolio changes. A portfolio is a sum of the parts. It is important to ask the right questions in the due diligence. Experienced investment managers know the questions you're going to ask them, and they have finely crafted answers for every single one of them. This is mostly because the due diligence process has been turned into a checklist with many legal and quantitative questions. These checklists can help, but they are just the first step. Many ignore the important, yet harder and more intangible qualitative questions. Judging someone's character may be of the more important aspects of the due diligence process, and one of the hardest. Remember, you are investing in people, not just performance. Hiring an investment manager is a business relationship where character and integrity matters, as you will be partnering with them for a number of years. When we think about due diligence, it really starts from a standard of care that we have for our clients, a responsibility to investigate and pursue rigorously the investments that we choose on their behalf. We believe our research process has many competitive advantages. We have a dedicated manager research team who follow a rigorous and careful evaluation process in the search and selection of superior managers. Our team, we believe, has a strong and unrivaled institutional memory who have been doing research since the mid-1990s. We have an established network and high-level access to key people in investment manager firms. We follow focused due diligence efforts covering investment, operational, and environmental, social, and governance criteria. Investment managers must demonstrate considerable strength on several criteria, such as investment skill, organizational coherence, clarity of business strategy, appropriate fees, and incentives and personal and professional integrity. We strongly favor long-term partnerships. We carefully select managers and often will hire them at an early stage in their development. Turnover is low in our partnerships and we don't chase short-term fads. We monitor and review our investment managers on a frequent basis. We have a broad coverage of the South African market across asset classes, and we keep an open mind to new investment ideas or strategies. Our local team is supported globally by our London-based team. We keep abreast of leading academic research and stay aware of trends and themes in local and offshore markets. We believe that no one fund management house has all the talent. Rather, we use specialists in most asset classes and will use active, systematic, and passive strategies. We believe that blending investment styles is key to success. By combining manager styles, this can increase returns and reduce drawdown and volatility within our fund solutions. We conduct deep qualitative and quantitative research within each style. We have an experienced and focused research team with access to proprietary quant tools, and we conduct over 250 plus investment manager meetings per year. In this chart, courtesy of the offshore asset manager Robeco, it shows how different investment styles perform in the 4 phases of the business cycle. In the long run, it shows that a blending of different styles, here illustrated by conservative equity strategies, which is Robeco's combination of value, momentum, and quality factors, offers the highest risk-adjusted returns compared to the market and all major single-factor indices. The evidence makes a strong case to blend various style factors to deliver on a more robust outcome across different business cycles. In trying to understand investment manager behavior, we classify philosophies or strategies and processes over multiple investment cycles where possible. We try to understand their idea generation or alpha sources and their portfolio construction, which covers the implementation and risk management approach. We look to identify good managers with good and consistent processes. We use various in-house developed and off-the-shelf quantitative tools. We analyze performance and risk attribution over varying time periods. Style biases, whether embedded or inadvertent, are analyzed. We analyze trading behavior and generation of alpha. We analyze where the returns came from and whether the investment manager had intended it. In addition, we analyze active share and tracking error. A number of risk flags are monitored when we have frequent engagement with investment managers. The main reasons we would sell an investment manager is when their portfolio does not reflect their investment philosophy and process. Inconsistencies become apparent, changes occur in their organization, or key individuals resign. Poor capacity management within the strategy, operational problems, or better options become available. The following shows that our robust investment manager research process has demonstrated its ability in selecting future winners and our patience to maintain long-enduring partnerships with our investment managers rather than chasing short-term fads. During the unfolding of the COVID-19 pandemic earlier this year, we took some actions to help our investment managers to increase their opportunity set and to provide them with more levers to deliver alpha in future and to take advantage of opportunities in the market. We increased flexibility in the underlying mandates of our various investment managers. We allowed them to increase their cash limits, Greater allowance was made to hold commodities via ETF structures. We also allowed them the usage of derivatives to improve risk management. At this time, our fund solutions also increased their bias to quality strategies to favor solid companies with more robust balance sheets. I trust with this session you will now have a better understanding of the robust investment manager research process that we follow and how we go about selecting superior investment managers and how this process supports our fund solutions. At Momentum Investments, we are confident that our robust investment manager research process helps us to identify different investment strategies across traditional and alternative asset classes, and different specialist investment managers which provide us with a competitive advantage to increase the likelihood of boosting absolute returns in our clients' portfolios. Thank you to our audience for dialing in.
Jaco Diaga, the head of retail portfolio solutions at Momentum Investments, will be explaining to us how they managed your clients' funds in 2020. Over to you, Jaco.
Thank you very much, Andile, and hello everybody. Having 20/20 vision refers to a person's ability to see something clearly and accurately from approximately 20 feet. Unfortunately, the fact that a person may or may not have 20/20 vision says nothing about one's ability to forecast the future or one's reaction to anything that may occur. One can therefore be forgiven for not being able to predict exactly what may have happened in 2020 or the impact thereof. But it's one's actions, reactions, and learnings following these extraordinary events that speaks to integrity and evolution of your thinking, both in a personal and a portfolio management context. Following a difficult end to the first quarter of 2020, the investment landscape has steadily become clearer, and our ability to react and position portfolios has improved greatly. This as the year progressed. Our portfolios are benefiting from these actions, and I will describe them in a little bit more detail later. But I firmly believe that we are on the correct path, and that the hard work, dedication, and patience will be rewarded. This to the benefit of our clients. Taking a look back over the past 12 months, ending October 2020, we are again reminded of the market impact the COVID-19 pandemic had. This both on financial markets and the increased volatility that followed since. As mentioned in our previous Outcome Matters session that you may recall we had in May, the second quarter of 2020 saw a strong and dramatic reversal from the fallout experienced during Feb and March. Unfortunately, equity markets meandered along during the third quarter as well as October to post moderate gains and have not yet recovered quarter one's losses. Local property continued to struggle, with the asset class still down more than 50% from where we were a year ago. Financial and domestically focused industrial shares have not recovered either and are still significantly down from pre-COVID levels and only marginally stronger from where they were at the end of March. Income-related asset classes rebounded strongly in the second quarter and delivered satisfactory returns since then, while general rand weakness over this period supported all offshore assets. It also helped cushion the blow and the sell-off experienced in offshore property markets, as this particular asset class encountered similar headwinds to the local market. Global equities, especially the now famous FANG shares, which include Facebook, Apple, Amazon, Netflix, and Alphabet, previously Google, provided strong leadership from a global perspective. And in a similar way, we experienced Naspers and Prosus leading the market. These shares also drove returns in a fairly narrow technology-led market. Multi-asset class solutions have struggled to deliver absolute and inflation-beating returns, this especially over the last year and the medium term, judging by the returns delivered by the various multi-asset class categories. We have witnessed a narrow dispersion in returns for the 12 months ending October, as the COVID-19 induced hangover hampered economic growth and eroded the possibility of decent market returns, especially from growth-oriented asset classes such as equity and property. Taking a closer look at the domestic equity market, we can clearly see how the post-March recovery took shape and the divergent returns experienced by certain subsets or sectors over the last few months. With specific reference to the Swiss 40 index, we can clearly observe the strong recovery made by the so-called global shares included in the index. These are shares that are traditionally referred to as rand-hedged shares and are sometimes considered to be of high or good quality, mainly due to their stable balance sheets and foreign earnings potential. Again, Naspers and Prosus come to mind. Interestingly, this cohort or collection of shares managed to gain more than 17% since the start of the year, therefore shrugging off any hangover from COVID. Stripping those two shares, Naspers and Prosus, out of the index brings us to the mustard line on the screen, which has now recovered from March's losses and are sitting fairly flat for the year. More disappointingly though, is the continued struggles and hardship experienced by the domestic component. This includes the likes of banks, selected insurers, and other domestically focused industrial counters. All of these have only marginally recovered post the COVID sell-off, and one can clearly observe the spread or the difference in return between the domestic and the global components. We have therefore also witnessed and experienced divergent returns between investment strategies. Whether you're looking at value, momentum, or quality, the return experience was very different. And as you'll see later in this presentation, how important it is to also manage a diversified equity strategy, such as the one we employ. As per the 5-year rolling return graph, we have witnessed how the average multi-asset class fund across the 3 major multi-asset class sectors struggle to deliver inflation-beating returns. The downward trend has unfortunately played out over the last number of years, from a point where especially the high and the medium equity average fund for a period over rolling 5 years to 2007 comfortably delivered returns in excess of inflation. Here, these sectors delivered anything between 15 to 20% above inflation. Following a lean patch towards the early and the late teens, markets again improved, and these funds again managed to post decent inflation-beating returns, albeit not to the same extent as the periods ending 2005 to 2008. Unfortunately, we are again in a similar situation to where we were 8 or 10 years ago, where low equity or conservative funds have beaten their more aggressive cousins. This for the 5-year period ending 30 October 2020, both as growth-orientated asset classes faltered and income-related assets delivered more normalized returns. It is therefore understandable that the momentum-focused fund-of-fund range, being market-linked, has therefore also fallen short of these lofty CPI-linked objectives. Remember, we set them back in 2012. The trend of reducing market returns is not a new or abnormal phenomenon, and the South African experience may very well mimic that of what we have seen play out globally. This is something we need to take note of, both in terms of portfolio actions and the management of client perceptions and expectations. In line with the previous slide, we have experienced a reduction in our portfolio average hit rates. That means, and it measures, the percentage of times that our funds are able to meet their stated CPI-linked objectives. And of course, this is measured over appropriate timeframes. Comparing our funds to the relevant peer groups, we continue to hold our own in both the low and medium equity categories, while we are calculating a superior hit rate on the more aggressive solutions. Looking back to the Momentum Fund of Funds inception back in March of 2012, we have managed to generate returns in excess of inflation across the entire portfolio range. Looking back to the last 3 or 4 years, it has been a disappointing experience and one that's in line with the one I discussed, from a market return and therefore a benchmark relative perspective. We have experienced a difficult performance cycle, especially referring to the first quarter of 2020. But as I will show a little bit later, we have managed to steadily claw back some of the earlier underperformance. And I believe we are correctly positioned for the long term, taking into consideration both the risks associated with selected asset classes, as well as the opportunities that present themselves currently. The recovery of the Focus Fund of Funds has been strong since the market bottomed late in March. The combination of active asset allocation, positive equity share selection, and other portfolio-specific activities, including currency hedging, has seen the funds deliver superior returns to place the funds in the top or second quartile since the market bottomed. We continue to look for attractive, risk-adjusted opportunities, this across the investment spectrum, and we are starting to see some of these actions taken earlier this year starting to bear fruit. It is again worth noting how important it is to stay the course, even through difficult market conditions. Resisting the urge to de-risk and move into cash at what could very easily be perceived as a point of capitulation could have seen investors lose out on a strong market recovery. We saw the focus fund of funds gain anywhere between 9.5% and 15% during this time, and this stands in stark contrast to cash that only delivered 2.6% over the same time frame. As mentioned earlier, we should also take note and plan for what could very well be a sustained period of low returns. Our internal modeling, coupled with work done by Herman and Sinisha, confirms that we are not necessarily on the cusp of exponential growth and associated market delivery. Expected real returns are being revised downward, and we are increasingly seeing more evidence, not only from a local, but also from a global perspective, to support this view. And it is one that should be incorporated in both an advisory as well as a portfolio management perspective. From a portfolio positioning perspective, it is again important to highlight how our portfolios are positioned relative to the peer group averages, as this helps to also appreciate and anticipate how our funds should perform relative to these very same peer groups. It is important to note, however, that our funds are not constructed on a peer relative basis. Our Focus 7 and 6 portfolios, although significantly underweight our strategic departure point for growth assets, are still marginally overweight domestic equities, while we are utilizing our full offshore allocation as allowed by Regulation 28. We have in fact reduced our offshore allocation when the rand was trading between 17 and 18 rand to the dollar. Based on our current positioning, the Focus 4 fund of fund is more in line with the peer groups, if you compare growth versus defensive assets, whereas the Focus 5 fund of fund is generally more aggressively positioned. On the more conservative side of the spectrum, the Focus 3 fund of fund is again closely aligned to the peer average, although in this instance, we have taken the decision to maintain a slightly larger offshore exposure. From an underlying building block perspective, I am very pleased with the outperformance generated from our domestic equity component. We have implemented a range of portfolio enhancements and a few mandate changes earlier this year, and these are already starting to add value. Our flexible fixed interest building block has detracted from value, with a large proportion of the underperformance being recorded earlier this year. This has had a proportionately larger impact on the more conservative solutions, where we generally maintain a larger fixed interest exposure. The fund is positioned with a bias towards the longer end of the yield curve. This position has not been rewarded as much as we anticipated, but we are still comfortable with the positioning, especially given the value on hand and the real rates on offer. Positive active performance from the income and cash components further added to returns, while the offshore component detracted over the short to medium term. We will shortly commence a structured process whereby the execution of the offshore component will move to specialist asset class specific building blocks. And remember, this will still be managed by our experienced colleagues in London. Still, on the global front, we have experienced the biggest relative underperformance of value globally. The value risk premium, or the value style, has not underperformed by the same margin and magnitude since the technology bubble in the 1990s. This has had a significant impact on the component's return, but we believe that the diversified nature of the offshore component, coupled with the actions mentioned, will put us on a firmer footing going forward. The last 9 to 12 months has certainly presented us with a lot to consider and a lot to internalize. And as a result, we have also seen increased portfolio turnover and activity as we position our portfolios for the opportunities and the risks evident in the market. From a portfolio management perspective, we have taken the following actions over the last number of months. Firstly, and as communicated previously, we have greatly reduced our property allocation, given both the known and unknown risks faced by the sector. Portfolio sales during Q1 was followed by further sales following the market bounce in April and again later on in Q3. Our offshore property allocation was also reduced, this time in favour of domestic equities. An increased allocation to bonds was also implemented in the portfolios, this time given improved valuations and higher expected returns. With that being said, we are, however, cognizant of the embedded risks given the increased debt burden on the country. We have also used currency weakness to reduce our offshore allocation, and we closed out our currency hedges as the rand strengthened. As I alluded to earlier, we have made a couple of changes to the equity lineup. In this instance, we removed 2 mandates or managers from the lineup, being Voort and Perpetua, and we included 91. These changes were driven from a strategy perspective and our internal desire to have a more diversified allocation between various risk premia, of course including value, quality and momentum. These changes are already benefiting the fund, but all the time we are continuing to monitor these and other components in terms of both the execution as well as the opportunity to implement mandate changes and flexibility. As we move forward into the latter part of 2020 and into 2021, we are cautiously optimistic that we may see a gradual economic recovery and a subsequent unlocking of value. While we do not expect this recovery to be as strong as some of our emerging or even developed market peers will experience, it does present some unique investment opportunities. Value abounds, and the same holds true across a few asset classes, but it does not come without any risks. Equities, especially those with a domestic focus, are presenting very interesting investment opportunities, but there are some headwinds to growth. The property sector is expected to remain under pressure. This on the back of disappointing rental reversions, rising vacancy levels, and the prospects of some companies either not paying or paying very reduced distributions. We are cautious on the bond market. Real yields are appealing, but the rising debt burden is of concern and the impact not yet fully known. We will continue to play an active role in the portfolio positioning, whether on an asset class, strategy, or mandate level. But one thing is certain, is that we have to move forward and we cannot simply drive by watching the rearview mirror. Thank you.
Next up is Emily Maoko, a fund specialist at Momentum Collective Investments, who will be the last speaker in our lineup. Emily, welcome on screen.
Thank you, Andile. What an incredible session during these uncertain times. As we approach the end of this year, this will be the last Outcome Matters, and it is appropriate to just stop and pause and thank you for your amazing support. On behalf of Kapil and the team at Momentum Collective Investments, we would like to thank you for joining us and being true loyal supporters of Outcome Matters and Momentum Investments. We hope we have managed to give you valuable insights to assist you to keep your clients invested. Amidst what has been an unprecedented year, markets have been incredibly tricky to navigate, and we know you have the task to assist your clients with the emotional upheaval that tends to come with this. We thank you for all that you do in this regard. Please note that our fund specialists will be responding to your questions after this event. Please do continue to keep in touch with us at the email address which will be displayed at the end. We wish you all the best and see you all next year. Stay safe and healthy.
In conclusion, we've heard the entire value chain of insights and input that Momentum Investment has used in their solutions. Sanisha described the likely market and economic outcomes for the next 5 years following COVID-19. Jean described how the investment manager research process supports our fund solutions. Yaku reminded us that there's no crystal ball when it comes to investing, but you need to stick to your financial plan and follow a consistent investment process. We also need to manage our expectations in terms of future returns, as these may very well turn out to be lower than previously experienced. Our solutions are recovering from the COVID-19 sell-off and are well positioned for an uncertain future as we emerge from the pandemic. And then Emily wrapped up the session for us. What a year, folks. What a year indeed. To finish off, we would like to end off with a short video to thank you for all your support during this year. We hope you enjoyed the session. Take care.
We start with breaking news. Wall Street is about to close any minute now. The Dow collapsing around 1,900 points today. Its worst single-day loss ever.
In times of adversity, when the odds are stacked against you, the true mark of strength lies with those who step up to the challenge and say, "This will not be my undoing." Today, we celebrate each and every one of you who would not falter, but instead rose up and held our name high. Success begins with every small step forward, even as the road rises up. Just as steel needs fire to harden, so too are we made stronger by our challenges. As the tides shift and change, victory belongs to those who ride the waves. Bright horizons are conquered by brave explorers who are not afraid of the unknown. Together, we can overcome the challenges we face. Our partnership is our strength. Our solidarity is our shield. Our collaboration is our weapon.